Bharat Iyer, MD and Head of Research for India at JP Morgan, says, or rather shares his market outlook in an exclusive chat with Nikunj. He believes that markets may remain subdued in the near term, but the long-term India story remains attractive. Let's listen in.
I think near term, I wouldn't be surprised to see outflows continue for a bit. But that's largely hot money leaving the country, which came in because of excess liquidity. But if you look at the fund flow into India, it comprises two parts. There is the hot money that came in and perhaps will exit. But there's also a lot of long-term structural money, which is really coming in because of the fundamental prospects. And I don't see that leaving in a hurry. I think that's here to stay.
Fed has indicated that they are confident that US economy will bounce back. And historically, we've always seen that whenever US economy has done well or is poised to go higher, that's excellent news for growth watchers.
Yes, it is. I think what's going to happen is, the reason the Fed is even contemplating tapering QE3 is because, they do believe that the US economy is on a very sound growth footing. And I guess, if the data points continue in the same vein, I think that's something to look forward to.
Well, what are the sound bites you're picking up from some of your clients? Because all we've seen in the last 10 days is massive outflows, there's outright selling, and foreign institutional investors, they've been net sellers to the tune of about $2 billion in a matter of just 10-11 days.
Well, I guess, there is a fair bit of nervousness. Because, this is an event for which I don't think everyone is completely prepared. And let's face it, it's a new experiment in financial history. And I guess, so people are likely to have their share of doubts. And, it takes a little bit of time to get used to the new situation that's evolving. And I guess what we're seeing is nervousness associated with that. And let's face it, if there is going to be some tapering of QE3, then markets will have to reprice risk. And, the risk premium will go up. And, that will impact valuations to a certain extent. And that's what the market's currently grappling with.
Bharat, corrections, no matter how deep they are, they always are bad. So what are you telling your clients? Should they use the current decline to their advantage to add more? Or in the near term, markets are poised to go lower and they should currently wait it out because they will get better entry points?
I think they will get better entry points. I think adjusted for the currency, I think there is perhaps another 7 to 10% to go on the way down.
And which is for the index.
Which is for the index.
That's a very bearish fall.
No, as I said, it's adjusted for the currency, and so it can happen in a matter of days. I mean, the currency slips 2 or 3%. I mean, the market goes down 5%, and we're almost there. But I see that's when value will start emerging, perhaps at those levels, and that's perhaps a better entry point in my view.
Even the markets have corrected. We've corrected by about 4% this year, and we've corrected about 14-15% in dollar terms. You've not changed your Sensex target. Why is that?
No, I guess, you recall when I was last on this show, I said that, value will start emerging in the Sensex somewhere between 17,500 and 18,000.
So we're getting there.
We're getting there. I think, we're getting there, and we did expect the rupee to depreciate as well. The rupee perhaps has, overshot a bit, but for the right reasons, and one can't argue against that. So in terms of our Sensex targets, perhaps we're still very much holding on to where we started. And that's the reason I said earlier that, once we get to somewhere between 17.5 and 18,000, that's when I guess, that will be an opportunity to start fishing for value.
So at a time when we could be staring at a world where liquidity will remain tight, dollar is going to go higher, commodity prices are poised to go lower, what should one buy and what should one avoid?
Well, I guess the immediate beneficiaries of rupee depreciation look most appealing at this point in time. We've been overweight those sectors for some time now, and we will perhaps continue with that stance for another quarter or two. And these are the usual suspects: IT services, healthcare, energy, the state-owned utilities. I think these are good places to hide in, because over the immediate term, we will have to price in the impact of rupee depreciation on inflation and perhaps live with lower growth for a bit. But, as this correction ensues, I think, there is an opportunity in the deeper domestic cyclicals. And, a month, 2 months down the line, who knows, I think, that would be a good opportunity to buy into them if you have a 12 to 18 months time frame in mind. But near term, we remain defensive.
So what could be that turning point? What could be that big, point when it is time to buy into defensive, buy into growth stocks?
I guess, from my perspective, I guess, what I'd really be looking out for is stability in the rupee. I think that would be the starting point, really, to start getting more aggressive on markets and then on domestic cyclicals. So if we see signs that the rupee is stabilizing, and that I think would be the first indicator that the economy is going to start stabilizing, and the key macro variables will start stabilizing. So I'd look out for the rupee to stabilize. Again, one needs to keep a watch on the monsoon as well, because it started well. And, if this pace continues, that perhaps gives us more leg room as we go into the second half. So over the next 2 months, what would I watch out mainly for? The rupee and the monsoons.
Mm-hmm. Is it time to approach pharma stocks with a pinch of salt? Because one by one, all the large cap pharma companies are now coming on US FDA scanner. First it was Ranbaxy, then it was Wockhardt, then it was Sun Pharma, and we all know what's happening to the smaller pharma companies.
Well, I guess you do need to take a stock specific approach. Anyway, pharma was always a sector where you could never, take a homogeneous view. It's a very heterogeneous sector. Each company has its own strengths. Each company, has its own niche markets which it focuses on. So, we've always been taking a stock specific approach. And, our key picks in the sector have been Dr. Reddy's, Glenmark and Ipca for a while now. They've all done well for us so far, and, we continue with that approach for now.
What's your take on financials?
Financials, I guess, near term we should see some stress because, let's face it, the monetary environment is not looking great. The central bank has its pulls and pressures to ease policy because while on the one hand, low growth and falling inflation would argue for a lot of easing, I guess they have to contend with, the pressures from the external side. So, monetary easing is not looking like a slam dunk anymore. In fact, if you were to see the options market, it's not pricing in a rate cut in July at this point in time. So, I guess that's an issue. A slowing economy and, also a lot of pressure from the FX borrowings that companies have on their balance sheets could also put stress in terms of credit quality. So I guess, one needs to, it's a large sector, it has great long-term appeal, but near-term I think it has its share of pressures. So, we'd stick to quality at this point in time.
You are underweight financials.
We are underweight financials. We have been underweight financials for a bit, and we'd stick to quality, and we'd perhaps look to get more aggressive only after a quarter or two.
But are you happy to pay that premium for private banks?
We are happy to pay that premium for private banks, mainly because, at this stage, as I said, we're looking to hide more than grow. So I guess, we're happy to pay it at this stage.
In general, should investors avoid companies which require additional growth or additional capital to grow?
Yes. I think, the entire capital, the entire space that requires a lot of capital will be under a lot of scrutiny at this point in time. Because one, companies have perhaps already taken on a lot of debt and, project implementation is running behind schedule. And, you're also looking at a very different global environment in terms of availability of capital. Not just now, but down the line too, over the next year or two. Because it is going to be difficult. Let's face it, quantitative easing meant there was a big carry trade going on. And that made, borrowing easy for a lot of companies because one, money was available cheap. Secondly, your currency was appreciating. Whereas down the line, if this trade starts unwinding, it means your currency is going to remain under pressure and capital is going to get more expensive. So I guess, most capital allocation decisions will come under a lot more scrutiny than they have over the last 5 or 6 years.
So tempting as it may sound, are you better off giving, or is one better off giving a skip to infra companies?
Well, within infra, as I said, we still like a few names. I think the state-owned utilities offer a lot of value because they're cheap, they're mostly defensive monopolies, they have very good balance sheets, and, let's face it, the demand for infrastructure in India is not going to go lower. So I think, those names still look very, very appealing. On the private side, yes, I think, it's a very stressed trade at this point in time. Pockets of value are beginning to emerge, but, you don't have the catalyst to take stock prices higher, at least not over the immediate future. So, you need to have a longer term time frame in mind. And secondly, we have to reconcile that some of these names may not make it. They could get bogged down by the excess debt that they're carrying and the project implementation problems they're having. So, perhaps 3-6 months down the line is a better time. I think on the policy front, we're seeing a lot of action from the government. And once, once we see all the policy action, announced, we need to say which amongst these can make it to the next level and who perhaps even despite these policy initiatives can't make it. And that's perhaps a better time to take a look.
Crude is down, gold has taken a knock, industrial commodities are getting absolutely whacked. When do you think markets will recognize that?
See, I think as far as the markets are concerned, they need to weigh both the pros and cons of what's happening at this point in time. On the positive side, as you rightly pointed out, commodities are taking a decent correction, and that is to the advantage of an economy like India. But the advantage of that commodity correction is also being partially offset by rupee depreciation. Secondly, I think along with the dependence on external energy, the other big vulnerability of our economy, particularly in the last decade and a half, has been the dependence on external capital. And, the correction in commodities also coincides with, capital availability becoming that much more difficult. So, we have to weigh the pros and cons, which is the reason, as I said, on balance, will we emerge out of it stronger? Perhaps. but you need to focus on quality.
This is June 2013. Hypothetically, if you are engaging in a similar conversation on the same forum exactly after a year, what kind of market do you think we could be staring at?
Well, I think a lot will depend on the outcome of the elections, because I think we are scheduled to have national elections in April, May next year. So perhaps the first half of next year, you'll need more political experts on your show than people associated with the markets. So I guess, it's going to be a very political first half in that sense. But on the markets per se, do I think markets will be higher at this point in time next year than it is currently? I think so. I think there is a case to make decent gains, 12 to 15%. But as I mentioned earlier, I think we first go lower there before we go higher.
So the script of how Indian markets have moved in the first half was largely dominated by global factors, rupee, US Fed, commodity prices. What will dominate the script of second half?
I think, one can't wish away the global interface. It's something that's here to stay. So I think markets will continue to, look at what's happening globally, particularly in terms of monetary policy by the developed world central banks. And, now that the Fed has announced a tentative timeline, whether it's going to stick to it, the data points, the adherence to that schedule, etc. But that said, I guess, the markets will also focus on the local, because, there are two or three things that you need to look at. One is, a spate of policy announcements have been made, and the markets will look forward to some optimism on execution there. You have the monsoons to look at. And then, of course, politics is something that most of us never tire at looking at. So I think it's going to be a balance. I don't think it's going to be very one-sided. We will be constrained to look at the global factors, but there's a lot to look forward to on the domestic front.
Well, historically, markets have always appreciated ahead of elections because on anticipation of a strong government, on anticipation of strong policy reforms. Do you think history may not repeat itself this time, but it will certainly rhyme?
I don't know. I mean, we all in the markets wish that history repeats itself and markets do rally ahead of the election again. That said, I guess, the experience in markets pre-elections is a little confusing because, while equity markets per se may have done better on a few instances and, may have not done so well on fewer instances, we've seen typically the rupee not do so well ahead of an election. We've seen, bond yields typically tend to spike up a bit. So it's quite a mixed bag. And I guess, the approach of markets towards the elections will also depend on, what opinion polls have to say. And so far, I don't think, a couple of the opinion polls that we've seen in the last quarter or so, they've not really suggested a very decisive end result. So I guess, markets obviously will take their cues from those as well. And I guess, we need to see a lot of clarity and, a decisive verdict for markets to really start getting enthused on politics per se.